Hi, everyone. I'm Bhuva Shakti, the Chief Sustainable Innovation Officer at WalletMax, a fintech startup revolutionizing fundraising for eco-conscious businesses globally, and the Chief Ethics and Culture Officer at Women in AI. I'm a corporate board director and C-suite advisor for social impact businesses and an angel investor passionate about economic empowerment and climate-friendly investments. I'm glad to welcome everyone to World Business Angel Investors Week as the country co-chair from WBAF USA and the president of Smart Cities Subcommittee from the Global Science, Technology, and Innovation team. As a senior executive director on Wall Street, I managed multi-million-dollar financial portfolios for the world's top investment banks, and I'm here today to emphasize that each one of us can help drive global financial inclusion. Financial inclusion accelerates economic growth by enabling individuals to invest in education, healthcare, and businesses, leading to higher productivity and incomes. We need responsible and sustainable access to financial services across bank accounts, credit approvals, insurance coverage, wealth creation, and mobile payments. Protecting consumers is critical by providing transparent, unbiased, and secure gateways for financial transactions, including ethical lending practices. With the exponential growth of digital banking and fintech innovations post-pandemic, how are we ensuring that there's financial literacy for everyone, especially women and the underserved communities? Research has consistently proven that broadening financial inclusion reduces poverty, increases society's living standards, and empowers financial institutions to be resilient to global economic shocks. The intersection of financial inclusion, entrepreneurship, women, and technology is particularly important in fostering economic growth and reducing gender disparities. Women often face a digital divide with less access to technology and global affairs and fewer opportunities for STEM education due to societal stereotypes and local community barriers. Online harassment and privacy issues disproportionately affect women and prevents them from accessing venture capital needed to launch and sustain tech-based businesses. We know that worldwide, especially in regions prone to cultural instability or environmental disasters, financially included women can better manage risks and contribute to social empowerment and pay equity. I see opportunities where technology and digital financial services integrate to provide better mobile banking for women in remote areas and also to customize fintech innovations to meet unique needs of women, such as microfinancing. We need financial literacy initiatives that can empower women to make informed financial decisions, to manage credit, and invest wisely. It's proven that governments and international organizations like the UN and WBAF can design friendly policies that encourage women-owned businesses to access credit investments with lesser roadblocks. However, we are challenged with bias and discrimination that prevent women from accessing startup capital or owning property. In some countries, legal frameworks restrict women's ability to open bank accounts or to start business. There's no tailoring of flexible payments nor microcredit lines that align with women's earning patterns. From an angel investment perspective, it's important to diversify access to women, minorities, and people from various geographical and economic backgrounds. Angel networks must implement policies that promote diversity and inclusion in the decision-making processes and ensure that investment opportunities are accessible to all. Creating specialized funds that aim to invest in startups led by underserved communities is crucial. Angels can also establish affinity groups for specific demographics, like women angel investors, and can provide personalized mentorship and training opportunities for early-stage entrepreneurs on how to effectively fundraise and pitch to investors, how to manage startup finances, and how to build scalable business models. Better collaboration with incubators, accelerators, and public-private partnerships will increase diversity among promising startups and also to continue funding in follow-on rounds to expand small businesses. We need an inclusive design and increased representation when it comes to adjusting the investment criteria from angel investors, and we can de-risk the entire infrastructure by increasing syndicated ventures. Governments, universities, public-private partnerships, and multinational corporations all play significant roles in promoting financial inclusion and entrepreneurship. Governments can create favorable regulatory environments, such as easing licensing processes or providing tax incentives. Direct funding, grants, and subsidies can lower the financial barriers for new entrepreneurs. Frequent changes in policies or lack of enforcement can lead to uncertainty, discouraging investment and innovation. Universities cultivate a skilled workforce, crucial for innovation and business management. They are centers for research, providing scientific and technological innovations that entrepreneurs can commercialize. Public-private partnerships can focus on specific projects like infrastructure, healthcare, or technology, directly supporting entrepreneurial environments. Multinational corporations, MNCs, can bring substantial resources and expertise to different regions, supporting local businesses through supply chains, partnerships, and market creation. Many MNCs run CSR initiatives that's corporate social responsibility, focusing on community development, education, and entrepreneurship. Advanced concepts of financial inclusion often incorporate deep tech. These are technologies characterized by substantial scientific advances and high-tech engineering innovation. Artificial intelligence and machine learning models can analyze non-traditional data sources for accurate credit scoring and personalized banking services and investment plans that enhance customer experiences. Blockchain enables decentralized finance, DeFi, and can create accessible peer-to-peer lending platforms. Internet of Things, IoT devices, enable more connected and seamless payments and better microinsurance. Big data analytics help financial institutions to predict consumer behavior and serve women much better. Quantum computing can revolutionize encryption and cybersecurity, making financial transactions more secure and building trust in financial systems among underserved populations. Advanced biometric technologies can enable secure authentication and user identification in remote areas. However, technology enablement presents challenges like privacy of user data, getting proper consent, and more importantly, the implementation of deep tech solutions can be complex and expensive for now. In the venture capital ecosystem, we should actively recruit investors from diverse backgrounds and ensure everyone goes through inclusion trainings for a supportive culture. Targeted funds specifically aimed at women-led and minority-led startups and outside major tech hubs is critical to close the funding gap. VCs can look beyond traditional metrics and consider of potential success, such as community impact or founder resilience. It's important to implement structured decision-making processes that minimize the influence of impact biases, such as blinded review of business plans or standardized scoring systems. Venture capital firms can adopt transparent reporting practices regarding the diversity of the entrepreneurs they fund and the performance of these investments. Transparency promotes accountability and can motivate firms to pursue more inclusive practices. In the private equity sector, we need longer investment horizons or tailored capital solutions that blend equity and debt. Allocate a portion of the portfolio to impact investments that not only seek financial returns, but also generate measurable social or environmental impact. Build diverse investment teams in terms of gender, ethnicity, and socioeconomic backgrounds. Risk management is crucial for ensuring the sustainability and effectiveness of financial inclusion efforts. We need to identify, assess, and mitigate credit risk, operational risk, market risk, liquidity risk, reputational risk, compliance, and legal risk. Impact investing and environmental, social, and governance, that's ESG criteria, are approaches within investment management where beyond seeking financial returns, there is an emphasis on generating positive and measurable social and environmental impact. Social impact metrics include job creation, poverty reduction, health improvements, or educational outcomes. Environmental impact metrics involve carbon footprint reduction, sustainable land use, and water conservation. Measurement tools and reporting standards from the Global Impact Investing Network, GIIN, and Sustainable Accounting Standards Board, SASB, help investors to track and manage impact performance. Lastly, financial inclusion and climate action are increasingly recognized as interlinked areas that can mutually reinforce each other. Financial inclusion can enable access to green finance for underserved communities, such as climate-resilient infrastructure. By providing financial services that enable access to affordable and renewable energy solutions, such as solar panels, we can reduce dependency on fossil fuels and improve living standards. We can distribute microinsurance products to protect low-income families from climate-induced such as floods and help them rebuild without failing into poverty. Financial services tailored to support farmers can support climate-smart agricultural practices and can increase biodiversity. In conclusion, during this WBAF Angel Investors Week, let's pledge to invest in women and in all underserved communities without losing focus on sustainability and scalability while measuring financial returns and impact. I welcome you to join me at the World Congress in Bahrain this November for my full report as the USA Senator. Thank you.